love the poll question on the page here. So true or false, geopolitics has shifted from being noise to a structural market driver. And I think we're seeing mixed results on the screen. And that makes sense to me. You know, history as a guide, I think investors have been paid to stay invested through geopolitical drawdowns in financial markets. But on the back of what the General was talking about just a moment ago, I think there's a certain gravity to this moment with repeated conflicts in 2026 that make this an open and live question for investors as we think about the outlook for the next several years. I really enjoyed your keynote presentation just a moment ago, General Gibson, so thank you for that. Some of the themes that stood out to me as I was rapidly scribbling notes in my notebook here was this idea of transitioning from the US as a dominant power to now moving into a world of what you described as a spider web of power and sort of a fragmentation of alliances. I think that could have some potentially really important financial market implications going forward. You also emphasized what General H.R. McMaster had told me, that economic security is now increasingly national security, and that intertwinement across the domains seems really important. This role of infrastructure in terms of building resilience across cyber, energy, AI, critical minerals being a key theme of focus for you. And then this idea of the commercialization of technology, the need for technology, but it's increasingly bridging across the economic and military domains, which I think is a really important and interesting theme. So for our session today, I think the goal of our panel is going to be to bridge some of these geopolitical themes and concepts and try to unpack what they could mean for the balance of risk for financial markets going forward. So to begin the conversation, Thomas, I'd love to start with you. We'll talk about Iran, I think, a little bit more in a moment, but one of the things that really stood out to me in our conversations leading up to this conference today was that you described this as a major moment, a major structural change in the global order and global power, something that you described as being an occurrence that maybe only happens once every 30 years. So could you unpack for our audience this regime shift that you see and maybe some of the market themes that you view as kind of flowing out?
Sure, thank you. And thank you everybody for having me here. You know, as part of my job at Wellington, I do spend a lot of time talking to policymakers, CIA, Pentagon, State, National Security Council, White House. I'm on Capitol Hill a lot. I do the same thing at NATO. I do the same thing with defense and intelligence experts all around the world. What you heard from General Gibson, you're not going to hear anything better or smarter than that. So first of all, thank you. And so a lot of what I'm going to say is a way to reflect these changes that the General was talking about into the market context. And I do believe, as investors, who are the three people that said that, who are the three people that answered correctly? I think those are the three people that are going to find alpha in this environment. But let me explain why I say that. So I'm an economist by training as well as a national security analyst by training. I love cycles. And what I really liked about the General's talk was she put this into a historical pattern, but I even pull back even more. And from my geopolitical perspective, right, geopolitics has cycles. Right? We all, and everyone in this room can appreciate what a cycle is. But geopolitical cycles are difficult to assess because they're so damn long. They're even longer than 30 years. If you look back in history, they tend to last 80 to 100 years. And at the end of every 80 to 100 years, you typically get a fraying of the international order. And in that period is when you get the conflicts. And I think from a structural perspective, this is the most important fact that investors need to grasp. And if you look at what's happening around the world, it is responding to this historical pattern. You tend to get the wars. Well, what do we have today? We have the biggest war in Europe in decades, obviously the biggest war in the Middle East in decades, potential catastrophic conflict in Taiwan, the East and South China Seas, the Korean Peninsula. I can go on and on. And so from a geopolitical history and a cyclical perspective, we're where we should be. It's just that no one here was in the markets 80 years ago. So this all feels new to us. And so the first thing I want to say is, yeah, this is not a new development in history, but it's new to everyone in the room. But from an investment perspective, that matters. Because every policymaker I talk to around the world, I don't care if I'm in Washington or anywhere in Europe or anywhere in Asia, what this destabilized geopolitical environment means is that every country is steering more into national security, period, often at the expense of economic efficiency. So we all grew up in a world of pro-globalization. We all grew up in a world where every policymaker was looking to better integrate their economies into this global system. That is no longer the priority, I'm sorry to say. The priority is, how do you make your countries, your industries, your companies, and of course your national security apparatus better adapted to this much more robust and much more competitive and much more fragmented geopolitical environment. And I think there are massive opportunities in that from an investment perspective, right, that we can get into, and I hope we will get into. So to me, there's this big structural change in the global order that is driving all the conflict, but it's also driving new opportunities.
Yeah, look, anything you'd like to build on there, General Gibson? Like, one of the other things that stood out to me from your remarks was you sort of talked about how the dynamism and speed of these conflicts seem like they're getting faster, where we're kind of going from 0 to 60. Does that inform maybe more frequent conflicts as well, or anything else that sort of stands out to you on the back of Thomas's?
I think it speeds it's like the ripple effects, like when you throw the rock in the pond, those waves are coming much closer together than further apart. I do think we really haven't even talked about what artificial intelligence is going to do in terms of an ability to accelerate decision or response. Right now, in terms of warfare, which is my area, artificial intelligence is being used to more rapidly identify targets, to more rapidly assess collateral damage, but it's still human beings making all the decisions. It's speeding the processes that give you information for decision, but we're not making autonomous decisions. And so, not to be too scary, but I think, again, we haven't really yet begun to see what impact artificial intelligence is going to have, and that might bring those waves even closer.
Well, that seems like a key issue across so many domains here. It's obviously been front and center for financial markets here for the last 3 or 4 years now as well. So thanks for,
If I could just add on that, because thanks, General, for bringing that up. I should bring you to all of my talks because you do such a good job of making my points. One of the things that I think the market narrative is missing about artificial intelligence is this core national security issue that flows through it. I don't talk to any policymaker around the world that doesn't see AI through a zero-sum approach, particularly when it comes to national security. Right? This is such a powerful tool that I think they're underneath all of the debates about wage and industry structure, wages, productivity, which I care about, like I'm an economist. But I think what the debate is missing is that national security is driving almost everything here, right? And whoever gets to artificial intelligence first, right, applied across their economic structures, but especially the military structures, is likely to have a huge leg up in this long-running great power competition that the General outlined. And so I think as investors, we want to be looking for those connections between the AI labs, the AI companies, with this national security apparatus. We're seeing those tensions play out every day. I'm sure everyone's following Anthropic and everyone's following Mythos and Maven and all of these frictions that we're seeing in the backdrop. But remember, as you think about assessing this artificial intelligence debate, flowing through all of it is this national security imperative. The Venezuela conflict, the Iran war is really showing just how far ahead the United States is in using artificial intelligence on a day-to-day basis in the military context, in the intelligence context, in the cyber context, both offensive and defensive. So thank you for bringing that up, and I wanted to underscore that because I think there's a big investment implication that runs through that.
Yeah, thanks for that. I mean, it seems like there's so many big forces hitting the global outlook here at the same time. You were just talking about AI in the military domain. Obviously, there's very real economic consequences and potential from that, as you were describing, around potentially stronger productivity growth, profitability, economic growth. So that's a key theme that we're focusing on in terms of upside potential from here. There's big issues around debt sustainability in the United States, which is related to this idea of economic security as national security. Record debt levels, not only in the United States, but across several of the other developed markets as well. That seems like a key force and issue for us. Energy security and power came up multiple times today. The power needs from AI, the power disruptions and disruptions to energy supply from the conflict right now. But also there's this sort of much longer term issue around climate change. But also our focus today with geopolitics seems like it's increasingly posing a structural force and change. So I'm wondering who in the room has had a change of heart around the role of geopolitics and its impact on financial markets in the last 5 to 10 years. Is anyone seeing this as a more significant issue today than maybe 5 years ago? I'm seeing about a half of the hands in the room. That's really interesting. So I've actually had a change of heart and a pivot in my own thinking around geopolitical risks and the role that they play on financial markets. I grew up studying the history of these issues, looking back over 100 years of data, and there's certainly episodes, the big episodes, where geopolitical events and wars can really impact global economies and financial markets, whether you're thinking about the world wars, 1973, September 11th. But there's a lot of smaller conflicts as well, really hard to predict as investors, that create shallow drawdowns in financial markets. The median drawdown on the S&P 500 index being 4% over this full history of geopolitical events going back 100 years, with a full recovery over the period of a month thereafter. And so I think for a lot of our longer term investors in the room, myself included, looking at that history, I was trained to believe, hey, we want to stay invested here. A lot of noise, maybe less signal, but it feels like that's starting to change. And you never know if the recent trend will perpetuate into the future, but we've just had so many conflicts here now in the span of just a couple of years. Russia, Ukraine in 2022, Venezuela just a few months ago, Iran now. This feels like the frequency of these conflicts is speeding up. And that matters to me as an economist, because we're facing more supply side shocks, and there's very real ramifications of that onto how you think about asset allocation and portfolio strategy. And I think we'll talk about this more, so I don't want to steal all of your thunder, Thomas, but if you think about government bonds as the simplest example of that, a classic portfolio diversifier and defense tool, government bonds are excellent at diversifying against traditional demand side shocks. If you think about recessions, that was the norm and regime that we were in from basically 1988 to 2019. If that's shifting and we're going to face more frequent supply side shocks going forward, government bonds aren't as reliable of a diversifier into that potentially new regime and world. And I think that argues for thinking critically about sort of broadening diversification and the tool set that we apply to portfolios for what feels like a shifting geopolitical environment. So I want to shift gears a little bit here from those structural issues, which I really enjoyed the discussion around, back to Iran. And General Gibson, I know you've already talked about some of your thinking on Iran here, that we've moved into this economic phase of the conflict now, a little bit of a stalemate, or I think in your words, an equilibrium. Yeah. So how do you see this evolving? You said a period of time. I think, Dan, great to see you again. You characterized it as maybe in the time frame of months. So that's important for us as investors. I think a big watch point has been on the duration of conflict. So I would love to hear a little bit more there. And I'm also really interested in how you see the lasting implications of this conflict with Iran, what we might be sort of left with in terms of lessons learned or ramifications.
Yeah, so I think it is important so I think we have to think about two futures. One in which the Gulf gets unstuck and we return to some normalcy that may not look exactly like what we had before, and then another where we don't. So in a return to unsticking the Gulf, I thought yesterday's demonstration was an important potential first step, needs to be replicated, needs to happen a lot. It'd be great if other nations chimed in, and for a variety of reasons they're not. But it's going to take a long, even if Iran threw in the towel like today and said, okay, that's fine, you know, you can have our nuclear material, it's going to take a long time to return to normal. It's going to take months, best case, to return to normal, because it's going to take a long time to get all those vessels out. And I've often said commercial confidence is the center of gravity. It's not the US president saying the Gulf is reopened. It's not the US Navy. It's it's based on business decisions of commercial entities and their insurers who decide that the potential for profit is worth the potential risk. And so they are watching, and they will need to see more than an episodic transit. They will need to see a pattern of transit before they have confidence to start flowing again. And then there's all the oil infrastructure that's been turned off because there's nowhere to store the product because the tanks are full and there aren't any ships. They will need to watch this routine transit of vessels before they have the confidence that, okay, I can turn the equipment back on, because as I understand, it takes days to weeks to reconstitute, and you're not going to turn it off and on. And then for that which has been damaged, say Qatar's LNG plants, months to years. So that's best case. That takes a long time to return to normal. And even at that, as we're unsticking it, it's not going to be the same rate of flow that it was before. I think what we have to think about, the other alternative, is an intransigent Iran that perpetually raises the risk of doing business there. And you know who I feel sorry for? I feel sorry for Qatar, Kuwait, and Bahrain. They're essentially now landlocked countries living on a lake. And so it may speed the construction of less efficient, more costly overland shipment routes. But I think we have to think about a possibility in which an intransigent Iran makes this a perpetual issue, and that there is a lack of business confidence to go back to what we had before.
So I would agree with that. Duration is the key question from a market's perspective. I think that's very clear. I would say there are at least three important long-term considerations that we're going to have to deal with as investors, no matter how this war ends. And I think these are important, and it goes back to what I was saying about these structural shifts. The first is, no matter how this ends, I think this conflict is going to accelerate the fragmentation of the global order. Mm-hmm. It's going to accelerate the loss of confidence that U.S. allies have in the United States as a security partner, and therefore it's going to reinforce this national security objective and imperative that I talked about at the beginning. So to me, you're going to see more focus on defense, more focus on other alliances that don't necessarily involve the United States, right? A continued focus on defense spending and all of these other things. So that's an acceleration of what's already been happening, but it's going to lead to more fragmentation, more geopolitical uncertainty, and more volatility for markets. The second thing I would say is that what Iran has demonstrated from a geopolitical perspective by targeting the Strait, right, this very important economic asset, I think we're going to see this playbook over and over again, not only in the Middle East, but around the world, right? They're demonstrating that it doesn't take much asymmetric power, a couple of drones, a couple of mines, to really bring a superpower to its knees, or to bring the global economy to its knees, right? So I think we're going to see that in other parts, other strategic waterways. There are 10 or 11 critical strategic waterways ranging from the Strait of Malacca to the Arctic eventually, but of course the Taiwan Strait. I think the Chinese are learning a lot about how to do an economic warfare piece of this. And then the third thing I'll say is that I think this is an acceleration of, and you mentioned this again in your comments, of alternative and green energy. Because I think it's showing that this focus on critical assets, critical minerals, strategic sectors, extends all across the board, but green energy is one way that countries going forward are going to use to reduce their dependencies on these strategic choke points. So I think, more of the fragmentation, right? We're going to see this, played out again over and over, I think, around the world, and then an increased focus on energy and other strategic sectors. And there are very important investment implications across all of those three dimensions.
Could I maybe follow up on that? So when we were talking about in the sunshine there, you also talked about some potential ramifications of this onto U.S.-China relations. Obviously, that's really important.
Yes.
As the two big economic superpowers in the world. We have the Trump-Xi meeting coming up soon. How are you thinking about that sort of dynamic and power balance on the back of the Iran war?
As important as the Iran war is, it is a sideshow. The real story in geopolitics this year, 5 years from now, 10, 20 years from now, is how the United States and China manage through this very complex, very fractured geopolitical environment. Essentially, it boils down to, can these two biggest economies, two biggest militaries, two biggest powers on the global stage, can we avoid catastrophic conflict, right? If we do, we're gonna have one path for geopolitics. If we don't, we're gonna have another path. So thank you for the question. I think putting this in the context of the US-China relationship is first and foremost. So I'll say a couple of things about the US-China relationship. First, I had circled this Trump-Xi summit at the beginning of the year as a really important geopolitical development because I thought it was going to determine, how is the U.S.-China relationship going to play out for the rest of the Trump administration. And I was fairly confident that both sides wanted to take some of the heat out of the relationship. Both sides wanted to reduce tensions, focus on domestic issues, focus more on strategic decoupling. So I was quite concerned when that got delayed. For these broader reasons. I'm glad that it's back on the agenda. And so to me, that is a positive signal. I think we should lower our expectations about what's going to come out of this agreement, or these talks rather. I don't think we're in for a grand bargain over Taiwan or anything that significant. But the fact that it's happening is a positive in my view, because I do think U.S.-China relations are on a strategic negative going forward. I also think the Iran conflict is important in this context because, well, you heard about some of the energy issues that China has, but I do think the president is unlikely to want to derail this summit by really attacking the Iranians over the next 2 weeks. So I think this in some ways potentially bounds the conflict. And then the other thing I'll say is she is in no rush to save Trump's bacon here, right? The longer the United States is bogged down in the Middle East, you mentioned the pivot to Asia, failing over and over again, the better that is for China, right? And so I think Xi Jinping is walking a fine line here of letting Trump dangle, but eventually trying to help in some way to restore stability.
So let's start moving from geopolitics onto its implications for the global economy and global financial markets. And General Gibson, I'll come back to you next, right after this. But Thomas, I want to start with you in terms of how you're seeing those ramifications. What does it mean for global business cycle dynamics? What does it mean for regional growth dynamics? Inflation, interest rates, what are the consequences of these themes that you're seeing?
Sure. So the point I really want to hammer home here, and I hope you will take with you, is that this new focus on strategic sectors, this new focus on national security will have economic consequences, right? And what I'm seeing and what I'm hearing, if I had made this comment 5 years ago, 10 years ago, it would have been about globalization, right? It would have been about how do we come together? How do we swim together? How do we, harmonize our economic and trade and fiscal and monetary policies? So that's not going to happen. That isn't going to happen, right? And you're going to have every country focusing on what are the core strategic sectors. And I think you're going to get a lot more protection and promotion of, let's say, 8 to 10 strategic sectors that both the United States and China think are critical in winning great power competition. So you can probably guess what I'm going to say, but it's semiconductors, it's space, it's next-gen communications, it's robotics, it's automation, it's drones, it's critical minerals, it's all of these things. But again, I put artificial intelligence at the center of all this because it has such a interconnectivity with all of these other things. And so what does that mean? That means we have a lot of opportunity as investors to find these strategic sectors, to find these opportunities, to find the tailwinds that are being produced by this newfound focus on national security. And the reason I mentioned that geopolitical cycles are long is that I think we're in the first inning of this change, right? So you want to be thinking about first getting more allocation to these sectors and these themes that have a lot of policy tailwinds behind them. And then the second thing I would say from an investment perspective and also a macro perspective is that this is going to be highly, highly disruptive, right? We're going to take all these supply chains all around the world, not take them all apart, but we're going to shift a lot of them, and we're going to have a lot of friction all around the world. Friction to me means differentiation, right? And differentiation means you can find winners and losers across the board at the regional level, country level, industry level, company level, asset class level. So I think from an investment strategy perspective, in addition to getting more diversification and getting more sort of a broader view of the world, I think you want a lot more active management to find these winners and losers. I spend a lot of time working with our alts teams, our hedge funds, our long-short teams, finding winners and losers at all of these dimensions. And so it's a terrible geopolitical environment. It's very scary. It's very volatile. But I think if you know where to look, the investment implications and the investment opportunities are pretty profound. And again, we're just starting here. And this is true in public, but increasingly in private markets as well.
Great. So, General Gibson, I'm not going to ask you to forecast the economy or financial markets, but I'm more interested in your crystal ball around what feels like a ramp up in military spending going forward. We have active wars. You also mentioned in your keynote about this push for maybe $1.5 trillion in U.S. defense spending in fiscal year 2027. So spend can matter for economic growth and market opportunities. How do you see those strategic priorities for the military evolving here? Where do you think that money is going to target and go to? You talked about shipbuilding, but what are some of the
ship and maritime will certainly be one. I think ballistic missiles, precision-guided munitions, artificial intelligence, cyber, command and control, those are all actually kind of related. I think autonomous, I'll say vehicles, but there's all kinds of areas where autonomy can be applied. I think anything related to Golden Dome and missile defense would be another. Really, everyone's going to come out ahead if the budget was approved, except the Army, which your ground forces have always been. There's just a lot of challenges there, and they tend not to benefit as much from these kinds of economic investments. What am I leaving out? It'll really be a lot of maritime munitions, precision-guided munitions. Space. Yeah. Space would be another. Yeah.
How do we get on the right side of the cost curve when it comes to, fighting drones?
Yeah,
we can't afford to spend $3 million for a $50,000 drone.
I don't know why we can't. I don't really know why we can't be more like Ukraine in that regard. I am not an acquisition expert. I can't tell you how many panels I've been in when people ask me, how do we fix, defense acquisition? I'm like, hey, if I had an answer, you should make me the DepSec stuff. It's like, I don't know how to fix that. But the American way of war, and really a lot of it has to do with the defense industrial complex, is just not optimized for rapid innovation of inexpensive capabilities. But if I were to pick one cliche that defined or described the conflict with Iran right now, it would be asymmetry. And I could list 10 different asymmetric aspects to it. And, the fact that you can cheaply produce little drones, and frankly, most of the damage that's happening on the Gulf side now is from drones, because we have exquisite interceptors, Patriot batteries and other things that are designed to intercept the missiles. We don't have that for the drones. And not only, drones are so asymmetric, and drone, kind of like IEDs used to be, they so rapidly innovate and change on both sides. You have to be agile, and we just are not good at that. And we're going to spend a lot of money on counter-drone technologies, a lot more money than our adversaries will spend on ways to attack us.
That seems like a big push, both
I'm sorry, that
towards
wasn't a good
innovation and spend. No, it's an
Yeah.
excellent answer. I think it rhymes with some of the themes that we're thinking about here. I think we do see a bigger push towards more defense spending. It's not only happening in the United States, though. It's happening globally here. U.S., Germany passed a big fiscal package in early 2025. Japan now as well, but also the need for more innovation around that defense spend, which private markets are often at the heart of those innovation cycles. And I think we're having some really interesting active conversations with venture and buyout opportunities and funds in the space. I agree with Thomas, at least around this potential for more inflation volatility going forward. If we're moving into a world of more frequent supply side shocks, that's really important for building resilient portfolios. If stocks and bonds start to become more correlated, I think it requires a rethink around broadening diversification. Kate talked about how listed and unlisted real assets have been a sort of shining star so far in 2026, but I think there's more opportunities beyond that. If you're thinking about macro hedge funds, cross-asset momentum strategies, volatility strategies, so a lot of focus and research in those areas. But I'd maybe feather in some optimism. Like the geopolitical angle in isolation can feel bleak, and I think there are some real issues and concerns, but we see a lot of growth potential here too on the back of AI. And if anything, what we've been doing over the last 6 to 12 months is ratcheting up our trend growth expectations in the United States on this rapid adoption curve from AI, the productivity and profitability potential there. Yeah. And so I think we have to be really careful about thinking about resilience, but balancing that with the growth opportunities that present themselves in the market right now. So we're at a really, I think, interesting and pivotal moment.
Can I get on my soapbox for a minute here?
Yeah.
This goes back to that original chart that you put up. I want to push back on the idea that geopolitics is a risk. And I know we've all grown up thinking, all right, well, geopolitics is something that hits the markets every few years. It goes up, right? Markets go down, but they come back, blah, blah, blah. I think because we're at this structural change, we should be thinking differently about what geopolitics is and how it actually fits into the macro backdrop. And the way that I think about it and the way that we talk about it at Wellington is, you have a whole investment mosaic, right? All of the variables that we all think about every day when we make investment decisions. I just think that, and of course that's growth, that's inflation, that's fiscal, that's monetary, right? That's all these things that we care about every day. I just think the geopolitics piece of that is increasing, right? It's becoming a core macro variable in the way that these other variables have been increasingly important. So the geopolitics piece of it is intersecting with inflation. It's intersecting with growth. It's clearly intersecting with fiscal policy. Then that creates problems for monetary policy, right? So, instead of thinking of geopolitics as this, exogenous risk that hits the markets every once in a while, I think you do a better job of predicting the future and allocating capital if you understand what's actually driving policy priorities around national security, around geopolitics, and then understand what are the implications. I would say stop thinking about geopolitics as noise and start thinking about it as a core macro variable. But to do that, you have to know what's driving the policy around the world, and then you have to know where to look.
So geopolitics is another important macro factor. I think that's a great anchor point. We have about 4 or 5 minutes until I'd like to open up to the room for questions. So maybe we'll sort of step up the tempo a little bit here on some of my hot button questions that we haven't gotten to yet. One issue we haven't spoken about yet on the stage is the Russia-Ukraine war. We're now, almost four or more years into the conflict, which is amazing to think about. So General Gibson, would love to hear a little bit more about your thoughts about the conflict in Europe. Are we at sort of a status quo situation that's likely to perpetuate? And just how do you see that situation evolving?
So it's not something I think about as much as Iran lately. And I think that Iran impacts Russia-Ukraine from several perspectives. One, Russia is a short-term beneficiary of this conflict in the Middle East because of the rising price of oil, because of the release of sanctions, that this is putting additional money into their coffers. Ukraine still scrappy and innovative and continuing to pack a punch and to inflict damage on Russia. I think Ukraine's limiting factor is their manpower, frankly, and their ability to continue to put people on the front. I think that sadly, and let me back up another, you've talked about I've talked about the decreasing reliance on alliances. And there's been a lot of damage done to the US-Europe relationship and to the US-NATO relationship. And the NATO decision-making process is extremely frustrating, but NATO has still been a significant deterrent to Russia. And some of the recent developments, in particular, the way in which the pre-planned withdrawal of troops from Germany was presented has also done a lot to erode trust and cohesion. And deterrence against Russia is about more than just numbers of troops on the ground. So these 5,000 troops that are going to come out of Germany that was pre-planned long ago is not going to provide Putin with any kind of operational battlefield advantage. But the manner in which this has unfolded has further eroded the trust across the Atlantic, and that's something that Putin can take advantage of. So I think that other European nations are stepping up. You mentioned Germany, some of the others getting serious about making real contributions to their own defense. That could make a difference, but I think sort of like the perpetual conflict between the U.S. and Iran in the Middle East, we're not going to suddenly wake up and find that Russia has accepted Western democratic nations on their border. And if Ukraine surrendered, there would be another Western democratic nation on Putin's border that he found unacceptable, perhaps the Baltics. And so in that regard, I think it will also be a continual point of friction.
Okay. And if I could just quickly add on to that, because I want to make an important point that you reminded me of, which is, first of all, I'm going to remain optimistic about NATO going forward. I do think that it has strategic value for everybody. There's a lot of political noise.
I didn't mean to imply it didn't. I just think it does degrade.
And one of my main questions always is how are military-to-military relations? They're still cohesive. I think your point about defense spending across Europe is going to add to NATO's capabilities, as have the addition of Sweden and Finland to the northern flank. But the other thing that I think is underappreciated by markets and most people is just how important the Ukrainian military is going to be once this ends.
Oh, yeah.
They're going to be very capable, battle-tested, and among the world leaders in understanding the war of the future, like drones and electronic warfare. So I think Europe is actually in a pretty good strategic spot once we get through this conflict. And again, we can be investing in this all along the way.
And I think Ukraine is already sharing some of those knowledge that they've gained.
In the Gulf.
Yeah,
right.
in the Gulf. Yeah. I just meant to say, I think the Russia-Europe friction
is not going
doesn't get resolved,
Yeah.
I think, frankly, while Putin is alive and in charge.
Okay, well,
Agreed.
Thank you, Thomas. Thank you, General Gibson. A fascinating conversation for me. I do want to open it up to the room now for questions. We have about 10 minutes left, so open to you.
This is a very quick question, but do we know how much Russia has spent in the Ukraine?
I don't know off the top of my head.
It's a lot.
Yeah.
But I think the key point is that the Russians have been successful in retooling their economy to war footing, right? Which means, I think Russia's economic potential going forward is much lower than it should have been. But I think that economic retooling along the way, and they've been pretty good at that, has allowed Putin to extend the duration of the conflict. I agree that the Iran war has extended that as well because it's filling up the coffers even more.
One over here.
Question for General Gibson. Where do you see space technology and development relative to global priorities?
Global priorities. Well, I think it's certainly a U.S. priority and it's a Chinese priority. I think it's pretty high, actually. I mean, I think those nations who can afford to spend on space, Europe at large, even some of like the Emirates and others, have space programs. I think it's fairly high. And it's certainly not an area where any nation wants to see their rivals gain an edge, because I think it's a bit of first mover advantage in that once you have an edge up there, it would be difficult to erode that and to take back space. No pun intended.
And I'll turn that question on its head a little bit and say that space is probably my favorite sub-theme in all of these emerging technologies that we talked about, for the simple reason that it's the ultimate high ground from a military perspective, which means the incentives for getting this right are so high. And you have all of these rapidly converging technologies that are enabling space at an advanced rate. And so I think that's something that we should be looking at very carefully from a capital allocation perspective, because we need it.
And I'd invert that to say, so many capabilities, terrestrial capabilities on the ground are enabled by space. So, we talk about space and people think of Artemis, which was fantastic and inspiring, or going to Mars. But I mean, it's like our everyday lives are dependent on space capabilities.
iPhone.
Just, precision navigation and timing, driving around with a map app. Financial transactions. We did a war game probably about 6 years ago, A Day Without Space, and we become like a developing nation after 30 days because we're so reliant on capabilities from space, whether it's communication or, again, PNT. Space is critical to the way that we live today, and people don't see it.
Yeah, and the way that I would translate that to an investment speak is, these are dual use civilian military applications, which means I think as investors, we need to be thinking more broadly about, well, what actually does constitute a defense stock, right? It's not just bullets, bombs, guns, right, missiles anymore. It's this whole network of exquisite emerging technologies that have these dual use civilian military applications. So the pool of opportunities is actually expanding.
Other questions?
So one here.
Yeah. Hi.
So you've talked a bit about sort of how there's pressure on inflation. There's also pressure on on spending and budgets. Can you sort of translate that into kind of implications that might occur for global bond markets and also for global currencies and the U.S. dollar?
Do you want to start?
I'll start and then you can hit this. So I get this question a lot. What's the risk to the U.S. dollar as the reserve currency status? And I do think that those pressures are building. I do think that China is making a concerted effort not to become the world's reserve currency. But what you see China doing is opening up a lot of currency swaps all around the world to facilitate the use of the RMB as opposed to the dollar. So it's chipping away at that dollar dominance. I don't think that is an immediate concern from a U.S. national security perspective, but you can see the pressures building. And I think that is, it's going to be dependent on U.S. policy going forward. It's going to be dependent on how does the United States manage through these debts and deficits that you mentioned before. And so there are questions that are building, but I don't see that as an immediate concern. I do think it's going to lead to, again, more differentiation across global bond markets, across different, because I think countries will have differing abilities to respond to these macroeconomic shifts. But the reserve currency question, I think, is central to how we think about this going forward.
Yeah, I would probably echo some of that and build on it. The U.S. is clearly on an unsustainable fiscal path. We're running unusually large budget deficits for good economic times. I think over time, it's very likely to put upward pressure on U.S. term premium if the situation gets worse and worse. But timing that is exceptionally difficult. When is the market really going to finally start focusing on U.S. debt dynamics? And I think that's a really hard question to answer.
When do the bond vigilantes come back?
Exactly. And one of the forcing events that's on my radar, although it could certainly happen before this, is part of the fiscal math that's particularly bad is we're getting older as a U.S. population. We didn't design our entitlement programs to be solvent over the long term. And so there's a forcing event in the early 2030s around the exhaustion of trust fund assets behind the ASDI trust fund program, that's Social Security and Disability Insurance, but also Medicare Part A in the early 2030s that will need to be addressed by the U.S. Congress. And so maybe it's then, that used to be 30 years ago when I was researching these issues. Now it's maybe 5 to 10 years from now. So I think we're getting closer, but still a really difficult issue to time.
There's the relative question too, because the U.S. is a leaky ship, but in an armada of other leaky ships around the world, right? So relative to other countries, we have challenges, but all these other countries have similar debt dynamics. So it's a global issue.
I think we have time for one more question. Yeah, Michael at the back.
I'm struck by two numbers that I've heard today, the $7 trillion that a relatively small venture AI entity needs, and the $1.5 trillion we think we need for a defense budget. As a capital allocator, as I'm thinking about ROI from that capital deployment, can you help kind of square, is 7 unrealistically high? Should we be shooting for more than 1.5 trillion? Those I can't reconcile those two numbers.
You want to talk about the?
Well, you know, it is an unprecedented budget request. I think some of it is strategically understandable, operationally understandable, in terms of, you know, clearly we already knew we had a munitions issue, but this war has highlighted some of the deficiencies in terms of maritime hardware and the need to really ramp up munitions. And when I say munitions have been a problem for a long time, when I was deployed to Iraq and Syria for the Defeat ISIS campaign, our use of munitions was affecting the ability to run ranges in Korea. So it's been an issue for a long time. In terms of executability, I think it may not be realistic to expect that everything that's being asked for at this time can or should be spent at this time, and that a number of things will be cut out and pushed to out years. For instance, if the shipyards are already, you know, at capacity trying to catch up, giving them more money this year or next year doesn't get you more ships because we don't have the ability to build them all. So I think there were a number of asks in that $1.5 trillion, and again, I haven't looked at it in detail, that are not executable in the near term and will probably come out. And I'm sorry, that's really all the more specificity that I'm able to provide on that budget.
I'll throw one more number at you, which is 10. And that's the number of consecutive years that we've hit global defense spending records, right? Mm-hmm. So we're at a global defense spending high. We're forecast for another 10 years of record defense spending. So I think that trend is important. It's indicative to what the priorities are, and I think that's likely to continue. But it's going to come at the cost of some of these other issues. And you know, there isn't an easy solution to this. But I think in a world that is so fragmented, so conflicted, and where you have more than 60 active military conflicts around the world, those priorities are clearly around higher defense spending, come what may.
Okay, so let's wrap there. I think some of the key takeaways for me, geopolitics isn't a risk, it's a macro factor. So I've written that one down, but a lot of big forces hitting the outlook here at the same time. And I think that requiring a holistic approach to balance growth and resilience in this increasingly complex world. So thank you, Thomas. Thank you, General Gibson. I really enjoyed it. I thought that was fantastic. So a round of applause for our guests.